Welcome students. This is a program for third year Bachelor of Commerce in the subject of Economics, semester 5. Course code is CEC 103 and the course title is Indian Monetary and Financial System. The title of the unit is Financial Institutions and Services and the module name is Commercial Banking, Introduction, its role in project finance and working capital finance. I am Mr. Akhil Gavas, Assistant Professor of Economics from Government College of Arts, Science and Commerce, Sankelim, Goa. In this particular module, we will be studying about the commercial banking, then the role in project finance and the commercial banking's role in working capital finance. At the end of this module, you will be able to understand the role of commercial banks in project finance and also comprehend the involvement of commercial banking in working capital finance. A commercial bank is a business organization which deals in money, that is lending and borrowing of money. They perform all types of functions like accepting deposits, advancing loans, credit creation and agency functions. And that is one reason why commercial banks are referred to as purveyors of credit as well as creators of credit. Besides these usual functions, one of the most important functions of banks is to finance working capital requirements of firms. Working capital advances forms major part of advance portfolio of banks. In determining working capital requirements of a firm, the bank takes into account its sales and production plans and desirable level of current assets. Project financing. Project finance is one of the key focus areas in today's world because of continuous growth and expansion of the industries at a rapid rate. Project finance is a centuries old form of financing high risk development oriented projects. Project finance is the long term financing of infrastructure and industrial projects based upon non-recourse or limited alternative of financial structure, where project debt and equity used to finance the projects are paid back from the cash flow produced by the project. They are most ordinarily non-recourse loans which are fortified by the project assets and paid entirely from project cash flow rather than from the general assets or credit worthiness of the project sponsors. A decision in part braced by financial modeling. Now, let us look at working capital financing. Firms also require working capital in order to produce products. The working capital is required to meet day-to-day needs of production activities of the firm. Following are the two main sources of working capital. First one is trade credit and the second one is bank finance. Trade credit is a form of short-term financing common to almost all businesses. In fact, it is the largest source of short-term funds for business firms collectively. In an advanced economy, most buyers are not required to pay for goods upon delivery, but are allowed a short deferment period before payment is due. During this period, the seller of the goods extends credit to the buyer. Because suppliers generally are more liberal in the extension of credit rather than financial institutions, small companies in particular rely on trade credit. Credit terms refers to the conditions under which the suppliers sell on credit to the buyer and the buyer is required to repay the credit. A typical way of expressing credit terms is, for example, 3/15 net 45. This means 3% discount is available if payment is made within 15 days and if this discount is not availed, payment is to be made on or before 45 days. Benefits and cost of trade credit. The first benefit is easy availability, second is flexibility and third is informality. Suppliers sometimes offer cash discounts to buyers for making prompt payment. Buyers should calculate the cost of foregoing cash discount to decide whether or not cash discount should be availed. Now, let us look at bank finance. Banks generally do not provide working capital finance without adequate security. The nature and extent of security offered play an important role in influencing the decision of the bank to advance working capital finance. Banks usually use overdraft facility. Under this facility, the borrower is allowed to withdraw funds in excess of the balance in his current account up to a certain specified limit during stipulated period. Under that, we have something called as a cash credit. Now, cash credit is a short term source of finance. Under cash credit, the bank offers its customer to take a loan up to a certain limit. Cash credit is also known as bank overdraft. Features of cash credit are: this loan is given to meet the working capital requirements of a company. It is given against a collateral security, and interest is charged only on the amount of loan taken by the customer and not on the amount of credit sanctioned. The advantages of cash credit are: it is an important source of working capital finance. Cash credit can be obtained very easily and quickly, and interest is charged only on the utilized amount. There are certain disadvantages of using cash credit. The rate of interest charged by loan on cash credit is very high. Such loan is granted by bank on the basis of company's turnover, its financial status, value of inventory, etc. So, it is difficult for a new and financially weak company to obtain cash credit. For banks, cash credit disturbs their credit planning. Next is purchase or discounting of bills. Under the purchase and discounting bills, a borrower can obtain credit from a bank against its bills. The bank purchases or discounts the borrower's bills. The amount provided under this agreement is covered within the overall cash credit or overdraft limit. Next, we have the letter of credit. Particularly, the foreign suppliers insist that the buyer should ensure that his bank will make the payment if he fails to fulfill its obligation. This is ensured through a letter of credit agreement. The bank opens a letter of credit in favor of a customer to facilitate his purchase of goods. Lastly, we have working capital loan. A borrower may sometimes require funds in excess of the sanctioned credit limits to meet unforeseen contingency. Banks provide such accommodation through a demand loan account. The borrower is expected to pay high rates of interest in such exceptional cases. These are some of the references that you can use for your further reading. Thank you.